Welcome back, everybody. This is episode 7 of the Weekly Juice Podcast. My name is Ryan Bevilacqua, and as always, I'm joined alongside my co-host, Cory Jacobson. Today, we're going to talk researching and analyzing analyzing real estate deals. Wow. So, Cory, you have a little bit of good news for the crew today. Why don't we dive in on your refi?
Oh yeah. Not this past Friday, but the Friday before, I closed on the refinance that I talked about a little bit on our Instagram story, where I mentioned that like 45 days ago I got a really good rate right as COVID-19 started picking up and these rates dipped. So I locked it in. I think at the beginning of or in the middle of March, I locked in this rate. And so, a lot of paperwork, a lot of processes going into it. I ended up saving like 1.5%. My rate was 1.5% lower than what it was when I purchased my property. I think I talked about a little bit about this in a previous episode, but just it turns out that the property that I own, it was a flip. So when it was purchased, it was worth like way less, and this guy fixed it up and then sold it to me. And it turns out that I was paying the taxes on it at the original value from like 2 years ago, and the city of Philadelphia hadn't adjusted the taxes. So I ended up doing this refi, and I'm gonna save like $40,000 to $60,000 over the life of the loan, which is great. But it turns out I'm refinancing to the exact same amount that like I was paying before in terms of monthly payments. So it was like kind of this weird, just like reassessment thing that they did, because the city of Philadelphia is so behind. But so a little bit of like not like a mishap, but it was just funny to see that. I was like, oh, okay, I'm not. It's a good thing for the long term, but not great for like what I thought I was going to get. I thought I was going to be saving like $200 a month. But so just to go off of what exactly went into the refi. So because there's all these social distancing restrictions, this closing process took like legit 30 minutes, but the lady came over, she was like a closing assistant. She works for a title company, and she came over, and originally we were going to like do the closing outside, and she's like, no, it's wet out here. And I was like, all right, I got to let this lady into my house. So we sat with masks on 6 feet away and like passing papers back and forth to each other. Just the total process of the refi. Essentially what I did was when you do a refinance, you have to have an appraiser come out to the property. So an appraiser comes out. It's like a total new assessment of what the home is worth now versus what it was worth 2 years ago when I bought it. Ended up appraising for more, not what I wanted it to, but it still was a good appraisal. And then you take out a new loan and you still have to pay those closing costs. But what I did is I wrapped my closing costs into the loan, so I didn't have to pay literally $0 up front. So I just put it in the loan because I knew I was going to have this property for a long time. So, that was kind of one of the things that I was doing as a research thing. Now it turns out it'll work out over the long term, but it was just like so weird to do a business transaction with all these restrictions. Like I was uncomfortable for a little bit, you know what I mean?
I have funny that you say that. I have a contractor coming in next week to do some renovations in the house. We're putting some crown molding up on throughout the kitchen, throughout the lower level of the house, then painting the banister, just to try to modernize essentially everything in the house, maybe doing some pictures, things like that. And they have to, contractors weren't, what do they call it? Like essential workers a couple of weeks ago, and they shut down for X amount of time, and now they're easing back in, but all their projects, like some people want them in the house, some people don't. So just even to update 2 projects, the contractor came over, he was strapped in his mask, he had gloves on and like little booties for his shoes. It was we sat 6 feet apart and like updated the change order, and it was just super strange. But I don't know, I'm excited to have at least something done outside of me doing it.
Yeah. that was part of the inspiration for this episode when we talk about analyzing deals, because some of the things that you're doing to your property is actually able to, maybe slightly, you're not doing like any major renovations, but you're actually able to, by doing modernization type updates, you're going to enhance the value of the property. And even if it's stuff like crown molding or flooring or windows, that's like one of the beauties of the whole real estate thing, is where, and why I love it, is because you have something that you can take and mold and increase the value. So for example, when the guy flipped my property, like it was worth like, call it like $70,000 when he bought it. He was a complete gut. He had to do, he did every single new system, floor, window, everything in the house. Like every single thing was new roof. And when he got done with it, it was worth, triple, quadruple, 5 times the value. So, and he didn't, he wouldn't be in the business if it costed him that much to actually do it. So flipping is a whole nother ball game, but you're just doing renovations while you live there along with appreciation, and that thing's going to be worth way more when you go to sell it or whatever you intend on doing with it when you rent it out down the line.
Thing, like redoing the bathrooms, people look at that, redoing the kitchen. We're redoing the kitchen, not completely, but
kitchens and bathrooms sell homes, right? That's what they say.
Yep.
This episode, we can kind of ease our way into this here. We talked about in our last episode building your all-star real estate investing team, and we don't always talk about real estate on this podcast, but this is another episode where we are going to talk a lot about real estate and analyzing deals specifically. I think it's important to the people out there who really want to get into this, maybe if they're on their first, second, third, fourth deal, they just want to, like, how do you find these deals? Like how do these things come to fruition? They don't just land in your lap, right? So
even before that, it goes to like why real estate again, just to kick it back in the beginning, like how do people generate wealth from real estate and why would I want to go about this? I think we kick it back to the beginning where we talk about pillar number one, appreciation, like the increase of the asset and value over time. We just talked about it. There's natural appreciation and there's forced appreciation, right? Naturally, properties go up typically 3% a year over time. Forced appreciation, you can up that percentage by redoing bathroom, redoing the kitchen, redoing certain things, putting up an extra wall to make it a 4-bedroom as opposed to a 3-bedroom. You know what I mean? There's a lot of different things you can add. So appreciation. Second would be cash flow.
Just to go off that, what you're saying, and as long as people have been living in homes, the home value has been going up as an average over time, not in like a 2-year span, or if you look at it in a minute time frame, but as an average over since homes have existed, it has gone up over time. So what we're talking about in relation to COVID-19 and how that's going to be affected, a lot more people are going to be working from home, but everyone needs a place to lay their head at night. It's not, commercial real estate might change, right? There's going to be a lot less people that are going to be going to work, but everyone needs a place to live. And that's why we're talking real estate. And guess what? If everyone needs a place to live, even more so now because of the fact that you might have to stay at home, I think it's going to, over time, increase the value of the appreciation even more so, even though right now we might be going through like this little dip, right?
Here's the thing, and here's how I view it. The value of a dollar keeps decreasing every year, right? There's just more money pumped into the economy. And I know we're at a little dip right now, but I don't see it going back. For as long as we've been alive, the value of dollar has not dipped. So, or has not increased, I should say. So it's just interesting. I think like you said, over time, it's just going to continue to appreciate in certain realms. And commercial definitely could be one that takes a hit. And we don't know for sure, but
we don't know.
For our purposes here and talking about the wealth generators, I'll talk about rentals and people essentially buying properties to essentially have someone else live in them and pay their rent, mortgage. And so we talk about cash flow. So essentially cash flow, once again, to reiterate from previous episodes, is the amount of income left over in your business after all the bills have been paid. So income essentially is the rent that someone would pay you. And expenses are things such as the mortgage, taxes, insurance, vacancies, repairs, capital expenditures, and utilities. You subtract them from one another, and then you come out with a number, that's your cash flow for the month. So just say, for example, you charge someone $1,000 in rent, and all your expenses add up to $500 a month. Your cash flow is $500. And obviously that's super, super top level. Well, we can dive into it, but that's why people get into it. You look at the stock market, that averages about 7% a year in some real estate deals, depending what you find. you can get over 8%, some in the 20, you hope for in the 20s or more,
Oh, easily, dude. I wouldn't buy a real estate deal. I'm not gonna say I wouldn't buy, but like I shoot for a minimum 15% in my real estate deals, or else I would just go into the stock market. Like, so
It's too much effort not to.
yeah, that's my exactly, too much effort not to. So that's my threshold. We're going to talk about thresholds and like what's a good cash flow number? Like what's your threshold for, we're going to talk about cash on cash return, and that's that number that you're talking about. I like to use 15% as a barometer.
Yeah.
We're going to talk about cash flow and like, Cory, some people say they want to buy deals and they get $100 a month in cash flow. For me, that's too low. Like I don't think
I texted you last night, what's your minimum? And you were
yeah.
like, blah, blah, blah. You know what I mean? If you think about it, all the effort to go through the whole buying process, right? Analyzing buying process, then filling your place with renters and then managing them, is it worth X to you per month? And granted, it's not just the cash flow, right?
Yeah,
We talked
right.
about appreciation. We talked, obviously there's two other buckets that I wanted to go into, but tax savings and loan pay down. They're paying your mortgage.
But that you're talking about that maybe it is worth it for some people. For $100 a month in cash flow, it really could be if you know all your expenses are going to be paid with that. And it's not a get rich quick thing. It's a get rich for sure. Like get rich definitely over a long period of time. So $100 a month could be good for me. And I'll talk about it throughout this episode. I like $300 a month as a minimum. 15% cash on cash return. I'm going to talk about it in this episode. $300 a month minimum. Ryan, do you want to go through just to reiterate some of those buckets for people, and then we can get into how people analyze these deals?
Sure. I just want to hit on one point before too. We talked about it in previous episodes where you want to buy assets that essentially will pay for your luxuries, right?
Mm-hmm. We always talk about that on this episode, on this podcast. I mean,
yep. So to explain it, let's say, for example, you have a car payment that's $400 and you
400 a month.
400 a month. Sorry. Yeah. 400 a month for your car. And you have really pretty decently nice car. And you want to wipe out this payment. Essentially what someone may do is buy a rental property and analyze the deal, which we'll talk about doing. And they come out with a $400 a month cash flow that pays for your car. You're done. You wipe out that bill and your mortgage is getting paid for, and you own a piece of property that should appreciate over time.
Yes. That's a good idea. So like for everything that you want, you can say like all these luxuries, that's kind of what I'm attempting to do. I haven't come up with the number yet, but like $400 or $500 a month for a car is like a really, in my estimation, it's a really nice car. So if you want that, go find an asset that can pay for it. That's exactly what you're talking about.
Think about what you're paying for each month right now, just as late 20-year-olds. And, we don't have kids, right? We're the significant others, but I think about car, I think about mortgage, and I think utility bills, like whatever. And then I consider that within like the mortgage realm of like, so car, house, and food.
Yeah.
And you're going on vacation. So if you can wipe out one of the four big ones, that's amazing. That's absolutely amazing. And
or how about this, bro? You add up, let's say let's say you spend $1,000 a month on food. What if you were able to, over the next 2 years, keep your spending at $1,000 a month on food and buy 2 properties at $500 a month in cash flow and say that those 2 properties pay for my food expenses for the month, right? Like, and then keep it at the same. Huh? Yeah. It's great.
Huge. So you're just essentially wiping out debt in a way.
Yeah, exactly.
Love it. Love that. So let's just touch real quick. So the 4 wealth generators that I went into, and the reason a lot of people get into real estate here is appreciation, cash flow, and tax savings, loan pay down. So pretty self-explanatory. I will dive into tax savings a little bit. When you're first buying a property and you take out a mortgage, a lot of your payment is going to interest as opposed to the principal. So the principal amount is what you owe specifically on the house. Then the interest is what you owe to the bank. Essentially, you owe both to the bank because the bank owns the house at this point, but it's what their rate that they charge you for lending you that amount of money.
Yeah. So if you have $1,000 payment, like in the beginning, your principal will be like in the payments, it'll be $300 a month, and your interest will be like $700 a month to make up that $1,000 payment. And then each month the next month it might go to 302 a month, 304, 306 until all the way 30 years. If you're on a 30-year loan, you'll be paying $999 a month and $1 in interest, right? That's how it goes.
Yep. And the cool thing not the cool thing, but a way to actually see this, it's called an amortization schedule. And
Yeah.
essentially, anyone that offers you, like the bank that offers you the loan or that you have the loan through, they have it on their website. So you can see how much per month each month throughout the entire cycle of your loan goes to principal and goes to interest. And as you said in the beginning, a lot of it goes towards interest. And it scares a lot of people. They're like, wow, I'm spending all this money and it's not even paying for the house really. It's paying these guys back. Well, you get a nice tax break when you go file your taxes for the first couple of years, or almost 10 years, I would say, because you can write a bunch of it off. So.
And when we say loan pay down, your loan pay down is accelerated over time. So especially if you can have renters paying that, you're paying that $300 a month. Year 2, it's by $350 a month. Year 6, you're paying $500 a month into the principal. So it's this acceleration, and then your loan goes down in terms of how much you have to pay, and the appreciation goes up. So you have all this equity in the home. That's what we're talking about there.
It depends. Yeah, I was specifically talking about the one that I live in and I don't rent out. So basically, but it's just even more of a benefit, right? If you have someone else paying for that for you, it's your business, right? It's your rental property. So that is just absolutely insane. And it's a huge wealth generator. So there's a bunch of other reasons and perks of, let's say, real estate, but let's talk rental properties specific. Mm-hmm. So I'm going to go through about 11 of them and jump in here where you see fit. But the first is the ability to purchase with leverage. So, we can dive super deep into this, but basically you have a lot of different scenarios where if you have wealth and equity in a property, you have a lot of escape plans here. So like you can roll it into another property.
Or else you wouldn't be able to purchase, not a lot of people in their mid-20s or late 20s can afford a $300,000 home in cash, right? That's the whole point of leverage, is you can put 20% down the property, the bank lends you the money, and then you pay it off over time. And essentially you have this asset that's appreciating, and you don't have to fork up $300,000 out of your own pocket. It just becomes nearly impossible when you're starting out to be able to do that. That's the leverage.
Right. And not sure if this is what you were alluding to, but for people that are purchasing for the first time and they're planning to live in it, some people only have to put 3.5% down.
Yep.
So it's absolutely insane where your leverage is crazy. You're getting a large chunk of money's worth of an asset for nothing. Yeah. So yes, leverage. Next is the ability to purchase for greater returns. We already talked about this. Stock market, typically 7%. You can get, you're hoping for at least 15, right? With property. I like the ability to manage my investment directly rather than just hoping the stocks go up or down. We talked about this. You can force appreciation. You can redo the floors, redo the kitchen, redo X, Y, Z. But it alters the value of your property. You can't go to Apple and say, oh, hey, I want to invest a little bit more money in this, so hopefully the stock goes up and I make a little bit more.
You're essentially going in blind when you go to stocks. I would never say that I know enough about a stock. Like you're the most passive you could be as an investor when you invest in stocks. And when you purchase a property and you think that, redoing the kitchens or redoing the bathrooms or redoing the floors would enhance the property by $50,000 and it only costs you $25,000 to do it, then you're getting that investment return right there by making those changes. So it's tangible. That's what we always talk about.
100%. I think we talk about another benefit is like it's worked for millions of people before, right? And people always need a place to live. So real estate is fairly stable and predictable. Right now we're in kind of a set, right, where it's the market, I'd say every 10 years goes down and has some sort of burst of the bubble in a certain way. Right now we could be because it's a pandemic, it's different than something we've ever been in. It's not just the ebbs and flows of the economic cycle. It's something absolutely wild and out of left field. It could alter it in a way different way, but if you plan for it to kind of be sort of like the 2008, I think you'll kind of be able to.
Well, the whole key there is, like not over leverage yourself. You say you can go in at 3.5% down, which is good, I think, for somebody who's buying their first home, but you wouldn't want to try to do that for multiple properties right now, because the reason why the banks are not allowing you to put 3.5% down, like they did in 2008 on all your properties or more of your properties is because then you're screwed if there is a 30% drop in the home prices. So I'm cool with putting 25% down on an investment property because the money isn't lost. It's just within the property. And I know that if I get a 25% dip in the market, which is rare, I still could sell I wouldn't sell it then, but I wouldn't be losing all of that money. So that's, kind
Right.
of a reference there.
Makes sense. So basically you're saying if you put in $30,000 in a property right now, you'd feel more comfortable as opposed to putting $3,000 in a property for the
Definitely.
fact that if it goes down 30%, you're going to owe way more than as if you had in 30
Yeah, you're
grand.
upside down on your investment, which means that if your home is worth $100,000 when you buy it, and you put $10,000 down, so meaning your mortgage is $90,000. If the market dips 30% from the 100 grand, you're upside down on your mortgage. It's only worth, you can only sell it for 70 grand, and you owe 90 grand. Again, we think it's a great way to get involved if you're going to live in the home. That way, there's no reason for you to have to sell it. But if you're going to buy an investment property, most banks won't let you put less than 20% down on a single family or 25% down on an investment property anyway. So the leverage is good, but I don't think you want to be over leveraged.
Right. And we'll talk about that when breaking down the numbers here. Like
Yeah.
pricing right now in the market is still really high. And it just because the market was booming. It was at its, I would say, if not its highest peak, one of the highest peaks it's been at almost ever.
Let me give you an example about the market booming. I'm not going to talk about specific sections of Philadelphia, but there's areas of Philadelphia that are just like absolutely skyrocketing with home prices and the amount of development that's going on. And I was looking up home values with Allie the other day, just like out of curiosity, in which neighborhoods are great to buy in. And there's a specific neighborhood in Philly that a home was purchased in 2014, 6 years ago, at $350,000, and it's worth $500,000 today. So if you can buy in a path of progress area at the right time, you just made $150,000 just by living in your property over 5 years. So it's like, you can't do that in the stock market.
Crazy.
It's unbelievable.
So there's a little bit, we say luck, but I think it's, what do they say? Opportunity meets preparation equals luck. So
yeah,
I think,
create your own luck. I like to say.
There you go. Just educate yourself and be ready to move. Right now, I know funds are tight for pretty much everybody, but if this thing dips and you have some cash on hand and you have the knowledge and you're ready to go, boom.
I know I'm going to be looking. I mean, I'm already looking, but I know I'm going to be ready to pull the trigger in probably somewhere between 3 to 6 months, maybe 9 months for sure.
Same here. Okay, moving down the list here. So we talked about fairly predictable. Millions of people have done it before, right? But there's also so much variety in real estate, right? Like there's commercial properties, residential properties, but then within each of those buckets, there's so many different other types of properties. Talk about single family homes, multi properties, branch that down even further. You have duplexes, triplexes, fourplexes. Then you get, if there's 5 or more units, that moves into a commercial property. So there's a lot of different things you can build out to. And once you find your niche, it's a takeoff from there, right? You can always dip into other types, but
well, when you say that, the takeoff, right? You're talking about like the snowball. And it's funny that you were saying that, because it took me like 3 or 4 years to save up for my first investment property. And then because I was able to save money and have income coming in, it took me only a year and a half roughly for my second one. And then it sounds like my third one, it might only take 9 months. So you kind of like build up this income as it coming in, and you snowball to the next one quicker and quicker. Really, I swear to God, I promise you, the first and second deals are your hardest. I mean, it gets easier from there, because not only do you learn, but you have more income coming in that can support your new investments.
It's like anything, man. I've seen a huge change in you. We lived together, right? And we talked about this. We were sitting on the couch watching a movie or something. We're like, dude, real estate, we might have to get into this. Meanwhile, we're also talking about the next car we're about to buy. Oh, should we get the Mercedes? Should we get the challenge? Like everything. And we're like, you're like, I think I'm going to go the real estate route. And then whatever, ended up going one way. You got the first property. And then I saw we talked about it, but I saw the picture of your second property. I'm like, dude, he's rolling. Like he's actually doing it. But the conversations that we had are so different. And I can tell you're way more educated in, and you're passionate about it. And the passion leads to doing more research and moving up the process even quicker to get the next one, because you see the light at the end of the tunnel. And I think it truly does take, like for me, I live in my first property, right? Like I don't have my first rental property where I'm managing a tenant specifically. And I just know once I have that one under my belt, I'm smooth sailing. Just not smooth sailing, because there's going to be a lot of ups and downs.
No, but it'll spiral you to the next one, is what you're saying.
100%. I know what in the work I do right now, I manage over 500 clients. You're telling me I can't manage a one client in a house? You
It's
kidding me?
all about managing expectations and also setting the expectation up front with your tenants. Like about, look, this is how it's going to be. This is a business. I'm going to be respectful. We're going to respect each other. And then that will go the best way in terms of, your relationship going forward. It's all about relationships, just like it is with your clients. It's about relationships with managing tenants. My tenants like me as a landlord. Like, it's not this like overarching, like lord looking down on them. It's just like some guy who they respect and they know that it's a business. So yeah.
When you say that, I was doing some reading, and one key point that stood out to me was the quote, work on your business rather than in your business. Don't treat your business as a hobby. Give it the respect it deserves. Like
Right.
these assets, you're not just buying for the sake of buying because you like managing properties. No, you're doing it to drive income for yourself, right? And you put respect on it and treat it like a business, like it's your own little baby that you're raising. It's just going to be so much more successful for you.
Well,
And
we learned that from Larry a couple episodes ago. Is that he puts in and we shared some of our thoughts on it on Instagram. He creates an LLC for each one of his properties, which is so smart, and it's something that I'm going to implement now. I hope more people will implement that. It's just a smart way to protect yourself. So that's what he's doing to make this not a hobby, a business for him, just like other investors.
right. Obviously, you're protecting yourself too, but can you imagine just you have, I don't know, just say Jacobson Inc. or something, and you
Yeah, it's
have your,
cool.
what is that what's called?
No, I'm saying it's cool. That would
Oh,
be
it's
cool.
cool. I'd be so proud of it. I'd be like, dude,
Yeah.
this is mine. 100. Why would I not give it the
That's a
respect?
great name. I was thinking about what a name for an LLC should be. I'm literally going to use that. I was like, CJ? Like, how? No, it can't be
Oh,
CJ. Like,
oh,
no,
Jacobson Inc., baby.
it's fire.
Mine's Bevilacqua Enterprises, baby. Let's get it.
That's
Dude,
gas. All right.
Wayne Enterprises, Bevilacqua Enterprises. Dude, I've been dreaming about this
Yeah,
day.
yeah, yeah. You're kind of like Bruce Wayne. Yeah, yeah.
I mean, so that side note, but, all right, next, let's go on to the next one here. We had a bunch of these I want to talk about, but I think we're almost at the end here. Purchase
Yeah.
of properties. So, well, I'll just cut it here, but besides multiple ways to profit, which we already talked about, I think one of the coolest ones is insider trading is legal. So we talk about the stock market and how legally you can't, if you work in the industry or you work on Wall Street, you can't tell your client information that you specifically know about a certain stock that's 100% going to go up. I don't know totally how that works of like what's dictated on what scale of like, oh, this is insider trading, this is not.
Right.
But in real estate, if I know someone in the industry and they see a property that's going to cash flow and they're like, dude, I know you're looking to buy a property in this area, check out this deal. It would be like me sharing information, and it's totally cool. Do it.
I think it's more even that, but also off-market deals. Like before something comes on the market, if you know somebody who's a contractor, you know somebody who's an agent, and they know of somebody who's looking to sell, seller financing, like all these types of things, for sale by owner, those things come up earlier. That's kind of like an insider thing that it's going to come up on the market, and there's totally legal to buy that. If you can get ahead of all the properties that come on the market, which is what I'm trying to do right now, is learn about properties that are going to be on the market. You can get your first crack at it before everyone else does.
So. Right. Insane.
So I think we want to go into here, like learning how to analyze rental property deals specifically, because it's easy to talk about it, but it's harder to, you can get in the habit of analyzing and not actually making you're paving your way to make this happen, right? But this is the start. If the numbers tell you it works, right? As long as you trust your numbers and you run it right. So what you don't want to get in the habit of doing is looking at $100,000 property and then understanding that you can get, look at a mortgage that's $1,000 and the rent be $1,200. Let me say that again. Mortgage is $1,000. Rent being $1,200, you're not cash flowing at $200 a month. You're just not. There's so many other expenses that go into it. So we're going to take a deal and walk people through right now. Just in, it can be a multifamily, it can be a triplex, but we're going to walk people through a deal to show you how we run our numbers to make sure a deal is a good one for you.
So just to reiterate here, a lot of people, when they go analyzing deals, super daunting, right? You go into it and you're like, hey, I'm not a numbers guy. It's very easily attainable. And once you grasp the numbers and once you can do it on paper, then there are calculators online that'll help you out. But to really grasp it in your head first and understand all the different terms and what each thing falls into, or what variable falls into each bucket, it'll help you so much further. So I highly recommend, we're going to go through this with you, but do the research on the side too, because this will be very quick for someone that's never done it. And, for me, I read one chapter over and over for 2 hours just in an analyzing real estate deals book. And I finally grasped it. I'm like, dude, I can do this so fast now. And then you just cruise. So.
It's really not hard, but you have to get the fundamentals. So what we talk about a lot, and there's a rule or a test out there that's called the 2% rule or the 2% test, which personally I just don't agree with, because I don't think that, at least in the area that I live in, that there's cash flowing properties that meet the 2% rule. And I'm going to explain what the 2% rule is right now. So the 2% rule is the value of your home, that the rent should be a good cash flowing deal with that. The rent would be 2% of the value of your home. So that would mean that if you have a $200,000 home or $200,000 property, that the rent should be $4,000 a month. And in this area, it just doesn't exist. Like, I'm not going to say never. I will never say never, but in my area, it doesn't exist. In some parts of the Midwest, it might. In other markets, it definitely might. But I like to use personally the 1% rule. If I can get a 1% rule deal, for example, just to use what I just said, $200,000 property, if it rents for $2,000 a month, I know that I can get a good deal out of it. So that's just like a quick rule of thumb to look at a property and figure out what the rents are. Some people might be saying, well, okay, how do I figure out what the rents are? One of the systems that I use is really, really easy. It's called Rentometer, rentometer.com. You just go on, type in your property, and you type in the amount of bedrooms, and basically it does all the analysis for you of the area and what other properties recently are renting out for that compare to yours, like comps on a sale of a home. I think Rentometer is really powerful. It's not gospel, just like Zestimates on Zillow are not gospel, but I think it's a really good way to just get a roundabout way. Does my property fit that 1% rule? Make sense?
Makes sense for me.
Cool.
Another one too, I don't know if you want to, let's just dive in here, because these are two rules of thumb that people typically talk about when they talk about analyzing deals. The 50% rule when determining cash flow. So essentially what this is, basically the rule of thumb states a rental property's expenses tend to be about 50% of the income, not including the mortgage, principal, and interest payment. So basically you divide the income in half and subtract the mortgage out of the payment. Now, we talked about this.
Yeah, I don't love this rule either, to be honest with you. I just think those expenses are way too high, but it depends on the market. It depends on the property. If you buy a property that's like 100 years old and nothing's been updated, like that could be the case. But I try to buy properties that are more updated with their bigger systems. So that can bounce you out of a lot of cash flowing deals, in my opinion, but sometimes it could work for some people. So, but first, to go in here, we have to define what cash flow, we defined what cash flow is already, but we have to define the cash on cash return. And we talked about it as it relates to an investment in the stock market, but the cash on cash return as it relates to real estate transaction, it calculates the cash income earned on the cash invested. So to put it simply, it measures the annual return that you make. Again, it's annual on the property in relation to the amount of that you have to put up front to get into the property. So we did an episode previously where it says that we needed, on a $250,000 property, you needed closing costs plus down payment, you needed like around $25,000. I don't have a calculator in front of me, but essentially the $25,000, you would want to figure out how much you make a month on the property, multiply it by 12, and then that number divided into your $25,000 would give you your cash on cash return. I said previously that 15% would be a good number for me, because it's at least 5 or 6% above what you think you can get in the stock markets. So we talked a little bit about cash on cash return. We're going to talk about personal cash flow and the threshold. People, I believe, if you've listened to our previous episodes, and if you haven't, go back and listen, because we defined cash flow. But my personal cash flow threshold is around $300 a month that I like to go above, because I just think that that's a good baseline number. Again, some people might want to invest in a cash flowing deal that gives you $100 a month or $200. And I would never say that I would never do that, but I like to use 300 as kind of the baseline. Right. Do you think that we should walk through a cash flow calculation on an investment property to give people some? Okay.
Yeah, 100%. I think we should go as basic as possible through each step so that people know kind of
Okay.
each step.
So let's just use this as let's say you have a $100,000 home purchase. And I realize that might, in some markets that might be low, in some that might be high. In our market, in the Philadelphia market, it is low, but in the surrounding suburbs and Jersey, Delaware, Maryland, and Western Pennsylvania, you can definitely get into properties that are $100,000. So I'm just going to use that number. Let's say that your property is $100,000 and you need $20,000 as your down payment, right? So your loan amount is $80,000. Again, what does the home rent for? Let's say you went on Rentometer. You were fairly comfortable that this property would rent for $1,200 a month. That meets the 1% rule off the bat, right? Again, use Rentometer to your advantage. There's other avenues that you can take to find the rent. Just running comps, talking to a real estate agent who might be able to run comps in the area on places that are leased out. So you have a $80,000 mortgage, and we can just use an interest rate of 4% because it's simple numbers. So on an $80,000 mortgage, your principal and interest would be $382 a month. Your tax, let's say your taxes are roughly $100 a month, because that's on a property that's $100,000. Generally, that's a decent number to use. You have to wrap in not only your taxes, but your home insurance. I have a home insurance being a little high here, but it's good to be conservative. So $136 a month for your home insurance, $382 plus $100 a month, plus $100 for your taxes, plus $136 a month for your home insurance. You do not have any private mortgage insurance because you put 20% down. Again, this is just a single family property that we're walking through here. It comes out to $618 a month. So that's the money that you pay the bank, right? Principal and interest, taxes, home insurance, $618 a month. So you have your $1,200 a month in your rent income, but you can't just subtract $618 a month and say I make roughly $600 a month in cash flow. What I like to use for the next three categories is a 5% of the rent as another expense. Again, we talked about maintenance. We're going to use 5% of the rent for maintenance, which is $60 a month. 5% of the rent for capital expenditures, saving up for those big things that break in your house. And then 5% of the rent for vacancy, for when you're filling your property. You know, you might have time in between tenants, just depending upon your market, how long it takes to fill it. So that's $60 a month for maintenance, $60 a month for capital expenditures, $60 a month for vacancy. You can go into utilities, but in all my properties, what I like to do is have my tenants cover the utilities. So electric, water, gas, and cable, those should be covered, depending upon the market you're in, by your tenants. So we can go back there and add up that principal and interest, taxes, home insurance equaling $618 a month, plus your 5% for maintenance, 5% for capital expenditures, and 5% for vacancy, $60 a month, $60 a month, and $60 a month comes out to $798 a month. Again, we did our rent, $1,200 a month minus $798 a month. Your cash flow monthly is $402 a month, which to me is a pretty good deal. Like I would buy a deal at $402 a month, and they do exist out there. I promise you that. So that, Rye, is just an example. And I don't know if you have anything else to add, but on a $100,000 property coming out with $402 a month in cash flow.
Think about what you could do with an extra $400.
Yeah, dude, that was the exact number that you used to pay for your car. I mean, if you have a car payment, that's $400 a month. It's perfect. To calculate the cash on cash return on that investment, let's say that your down payment was $20,000 because you put 20% down on a $100,000 investment. Your closing costs are let's say roughly on a $100,000 investment, your closing costs would be potentially $6,000. So I have a calculator right here in front of me. I can just do that. Your cash flow, we're talking about $402 a month, right? You multiply your cash flow, 402, you multiply that by 12. That's $4,824 a month, okay? And you divide that into the amount of money that you had to pay up front, which was $20,000 plus $6,000 in closing costs. So you divide that into $26,000, and you have an 18.5% return on investment. Your cash on cash return for year one, just year one, And they generally go up because you could potentially raise the rent, but for year one is 18.5%. That's a great deal, in my opinion. Great deal. And they exist, like I said. So that is just an example of how to calculate cash flow. Again, we can walk through this visually, but if you had a pen and paper, you can replay that segment there, and that's just a basic deal on how to get to your cash flow number and also your cash on cash return number.
Just to reiterate, 402 a month times 12 months, you have the roughly 4,000, a little over 4,000 per year. Divide that by the original 20K you put down, and that's where you get
26,000 plus closing the row, right? Yeah.
Okay.
Yeah, we're going to post that clip that I just did on social media, so it's easy for you to find, and then you can just replay that over and over to go over your cash flow calculator. And it's really powerful. You just have to trust the numbers. You don't want to do this and analyze the deal 50 different times and say, well, what if a tree falls on the house, or what if it gets struck by lightning? And then you have to, you'll drive yourself fucking insane if you do that. So the whole point is that you want to be conservative, but you want to trust the numbers. They really work.
If you're not getting, when you do the numbers, say you fall in love with the property, the way it looks, the number of bedrooms, all that, and you are specifically using this as an investment property, and you get a number that is negative or zero, and you're not going to have any cash flow based on the months, don't play around with, oh, maybe I can save I don't need to put the 5% towards capital expenditures. I don't have to put the 5% towards whatever. Like, basically what I'm saying is you have to trust the numbers and move on. You can't go, it's logic over emotion at this point.
Exactly. You don't want to be emotional in a real estate investment, but also what I didn't add in was expenses for property management. So that I'm running this deal based on the fact that you're going to manage your own property. So there are other property management can be anywhere between 6% and 12% of the rent each month. So for this property, it would give you a less cash on cash return and less cash flow each month. But I manage my own rentals, so that's why I did it like this. And again, right, to go off what you're saying, I know investors that say, if I think this market's going to boom in the next 5 to 10 years, they'll go in at a break-even cash flow, and because they think it's going to work. Personally, for me, it doesn't work. I'm not like at that stage where I can have something go bad and have money. I just don't have endless money to blow. But some people that are established and they know where the areas are going to rise, they're cool with $100 a month, or they're cool with breaking even, or even cool with losing money if they really think it's going to explode. And that's just their thing.
To that point too, I think when you're starting off in the beginning, I think a lot of people should include the
property management
just for the sole fact of, if you're going to keep this property in your portfolio long term, say you have 20 units at the end of, not the end of it, but like midway through your journey here, and you're like, I don't want to manage these anymore by myself. Then you already factored in the numbers in the beginning, and you don't have to go back and like work with them. It's already factored in, and at least you're being more conservative. And You don't have to, but I think for someone starting at the beginning, at least when we're trying to practice the numbers, it might be a good idea.
Yeah, and again, we're talking about this as rent, and that's just rent day one. If you're buying a steady market, you don't have to buy in a booming market, but if you buy in a steady market, that rent at $1,200 a month in 2020 should or could potentially be $1,500 a month in 2025, or $1,700 a month in 2027, and your mortgage is fixed, right? Your taxes might go up, but your mortgage is fixed. So that's why we think that real estate is such a good deal, because you're buying a mortgage that stays the same over time, and generally home prices and rents go up. So that's kind of our example there of, analyzing a deal. And if somebody has a specific deal they want us to take a look at, I would be happy to. I love running numbers. So if you want to shoot stuff over to our Instagram account, I would run through it with you. I'd be happy to, and just take a look. But yeah, I think we kind of covered, I don't want this episode to go too long, but I think we kind of covered an example of how to analyze a deal. You just have to make sure that your numbers are right, and trust it, and then make the move, right? That's it's the hardest part, but that's when you start having the most fun. So we can do if Ryan wants to go into our last drop here, this is kind of the inspiration behind analyzing these deals and running the numbers and finding the deals, right?
Sure. Yep. So for me, I'm going to recommend my last drop of the day, or last drop of this episode, is going to be another book recommendation. This week, it is the book on rental property investing by Brandon Turner. Here's the front cover. I highly recommend this book. A lot of the books by Bigger Pockets are amazing. This one specifically covers everything from the inception of you deciding to essentially deciding that rental property investing is something you want to do, to analyzing deals, finding deals, managing tenants, finding ways out of deals. It covers the whole flow of everything. So
kind of a good overview of the movement in itself, right? I've read the book. It's good. I really like it.
Put it this way, he is the co-host of the Bigger Pockets podcast, and I've heard his voice thousands of times from listening to the episodes and reading this book. It was just like him playing my ear reading it. But there's so many invaluable things. I'm using this as my Bible moving forward. So I highly recommend it. I think it's about like $40 on Amazon, something like that. So it's a little pricey, but definitely worth the read.
Awesome. Does that take us out?
I think that takes us out. That wraps us. So thank you, everybody, for joining us. That concludes episode 7 of the Weekly Juice podcast. And make sure to follow us on Instagram at the Weekly Juice Pod. And we are streaming on all platforms, including Spotify, iHeartRadio, and
Apple. No, yeah.
Apple.
But by the way, we want to talk a little bit about this. We have our next episode is not talking about real estate. It's actually talking about if you want to learn how to go on vacations for free for the rest of your life, you have to listen to the next episode. Like, this guy blew my mind, and it's your cousin Rye, but I was like, oh my God, I'm going to do this. It's getting into credit card hacking and just how the benefits of credit cards and how they can literally pay for your vacations. So it's pretty cool. So I would definitely be on the lookout for that that episode the following Wednesday after this episode 7 is released.
I highly recommend it. We're going to have a lot more guests appearing on the podcast here. So if you would like a new spin on things and are sick of just hearing Cory and I chirp amongst each other, we are going to have plenty of people joining us, and we're excited to have you on the journey with us.
Let's get it. See you guys.